Cumulatively from January, exports from the small-scale sector reached 51.5 tons, which is valued at approximately $5 billion US.
For decades, the global resource narrative has been painfully straightforward, almost a cliché. The West set the rules, African nations supplied their treasures, and the vast majority of the profits ended up securely locked away in London's financial vaults. But that long-standing story is now taking a dramatic and perhaps irreversible turn. In a move that has sent shockwaves through the commodity markets, the governments in Accra and New Delhi have just sealed a staggering $50 billion gold partnership. This is not just a trade agreement, it's a fundamental reimagining of how gold flows, who profits from it, and what it can be used for. If this monumental deal holds, it promises to flip the script, reroute the world's most coveted metal, and reshuffle the global economic balance of power. The old playbook, written by colonial powers and guarded by Western financial institutions, has just been decisively tossed out the window. This is far more than just another trade deal. It's a profound state-to-state maneuver, a calculated bet that gold, the bedrock of wealth for millennia, can achieve what decades of foreign aid and conditional loans have failed to accomplish. At its core, the agreement establishes a direct and steady stream of bullion from Ghana to India. Ghana, Africa's top gold producer, is set to supply approximately 20% of its national output every quarter. In return, India secures the largest and most ambitious offtake agreement any African nation has ever signed. The financial mechanics are just as revolutionary as the scale. Payments will be settled partly in Indian rupees and partly in Ghanaian cedis, a structure designed explicitly to circumvent the traditional gatekeepers of global trade. There are no middlemen, no London Bullion Market Association banks skimming exorbitant fees, and most critically, no reliance on the US dollar to facilitate the transaction. While the intricate details are still being ironed out, the headline figure alone, $50 billion spread over 5 years, is a sum that completely overshadows Ghana's entire national budget for 2023. It's a move of immense economic sovereignty, signaling a new era of South-South cooperation. To truly grasp the significance of this moment, we have to confront a problem that everyone saw but few were willing to address. Imagine a massive conveyor belt stretching from West Africa to Europe. On one end, in the red dust of mining towns like Tarkwa, artisanal miners dig for glittering ore under the hot sun. On the other end, after a brief stop at a Swiss refinery, those 12.5-kilo bars, the standardized assets of global finance, disappear into private accounts and central bank vaults in the West. All the while, Accra struggled to fund its schools, pave its roads, and keep the lights on. The numbers are staggering. Between 2019 and 2023 alone, an estimated $11.4 billion worth of Ghanaian gold simply vanished through informal channels and smuggling routes. That's $11.4 billion on which no taxes were paid, no royalties collected, and no official jobs were recorded. As this wealth bled out of the country, the cedi lost its value, public debt soared, and international analysts pointed to the textbook diagnosis of commodity dependence. In plain language, this meant Ghana appeared rich on paper, but remained poor in practice because it controlled neither the paper nor the metal. This is where a quiet revolution began. Last year, Ghana's government launched a powerful new state agency with a deceptively simple mission: to become the first and primary buyer of the nation's own gold. This entity, which functions as a domestic gold purchasing program, insists that all large-scale mining companies sell 20% of their output directly to the state, in local currency, before it can be exported. The impact was immediate and transformative. In its first full year of operation, the program channeled billions into the nation's reserves and dramatically boosted the country's total physical gold holdings. Before the program began, Ghana held a modest 8.7 tons of gold. Within months, that figure had more than tripled to over 30 tons. This sudden influx of hard assets had a stabilizing effect on the entire economy. The cedi, which had been in freefall, found a floor. Inflation began to ease. For the country's thousands of small-scale miners, the program was a godsend. Suddenly, they had a legal, state-backed buyer willing to pay fair market prices in cash, right at the source. The shadowy smuggling routes that had siphoned off the nation's wealth began to dry up overnight. After all, why risk prison and exploitation when the national treasury itself is offering a better, safer deal? This newly assertive and gold-rich Ghana quickly caught the attention of another major global player, India. India is, without exaggeration, a gold-hungry nation. The metal is deeply woven into the fabric of its culture, economy, and spiritual life, powering everything from wedding celebrations and religious festivals to household savings and institutional investments. Last year alone, Indians consumed over 800 tons of gold, and demand continues to climb relentlessly. But this insatiable appetite came with a significant challenge. Global gold prices had jumped nearly 30%, the rupee showed signs of volatility, and the country's economic planners were wary of stoking inflation. New Delhi urgently needed a stable, high-volume, long-term source of gold that wasn't subject to the whims of Western market makers. Ghana, now flush with a formalized supply chain and the political will to bypass traditional markets, was the perfect partner. For Ghana, India represented a reliable buyer who wouldn't haggle over refining fees or create opaque payment delays. It was a match made in macroeconomic heaven, turbocharged by a shared geopolitical vision. For India, this is also a strategic move to counter China's pervasive influence across the continent, adding a layer of competitive urgency wrapped in shiny 24-karat metal. If you want to understand how power is shifting in the 21st century, you have to read the fine print. And the fine print of this deal is where the revolution truly lies. We know that India will prepay a $5 billion portion of the total sum this year alone. This capital is not a loan, but an advance payment earmarked to kickstart critical infrastructure projects in Ghana, including upgrades to railways, the construction of new refineries, and the development of solar power plants. In return for this upfront investment, India gets first right of refusal on approximately 60 tons of Ghanaian gold annually. The pricing mechanism is another stroke of genius. It's linked to the London daily price, but with a small mutually agreed upon discount. Critically, payments will be split, 40% in Indian rupees and 60% in Ghanaian cedis, completely bypassing the US dollar. Furthermore, both central banks will store their bullion in their own national vaults, not in London or New York, a detail that has sent a palpable wave of unease through the brokers of the City of London. And in a final assertion of autonomy, the contract stipulates that if any disputes arise, arbitration will be handled in Nairobi, not New York or Geneva. The Global South is no longer just playing the game. It's writing its own rulebook. Beyond the high-level geopolitics, this deal promises to have a tangible impact on the ground. The agreement includes provisions for new state-of-the-art refineries to be built in Ghana's Ashanti region, a 300-kilometer railway spur to connect mining hubs to the port, and 1,000 vocational scholarships for young Ghanaians to study metallurgy and geological sciences at top Indian institutes. It's a framework built on mutual benefit. While Indian companies receive favorable tax incentives for their investments, Ghana has secured technology transfer clauses that mandate the hiring and training of a local workforce. The first cohort of Indian geologists has already landed in Kumasi, and the initial buzz is one of amazement. Reports suggest they are discovering vast, high-grade ore deposits in pits that were previously dismissed as unprofitable, a judgment made when gold was trading at a fraction of its current value. When a nation like Ghana makes such a decisive move, its neighbors take notice. Across West Africa, finance ministries and central banks are watching intently. Ivory Coast is reportedly revisiting its own gold royalty laws, while Burkina Faso is considering a similar state buyer program to formalize its artisanal sector. Even Nigeria, a nation traditionally myopic in its focus on oil, is said to be dusting off old mining licenses, suddenly interested in the solid wealth beneath its soil. If Accra can successfully demonstrate a model for monetizing its natural resources without the punitive strings often attached by the IMF or World Bank, it could establish a powerful new precedent for economic sovereignty across the entire continent. That word, precedent, might cause shudders among Western financial consultants, but in the corridors of power across Africa, it's now being whispered with the reverence of gospel. This tectonic shift has not gone unnoticed in the traditional centers of financial power. The entire architecture of the modern gold market, a tidy and immensely profitable system, was built and is still dominated by institutions in London and Washington, which control the pricing, storage, insurance, and lending against the metal. Suddenly, the single largest new flow of gold in decades is being rerouted to bypass their vaults entirely. Analysts at major Western banks are already issuing warnings about liquidity fragmentation, a sanitized piece of banker jargon that translates to "we are about to lose a lot of money in fees." Meanwhile, politicians in the West, who have historically shown little interest in Ghana, are suddenly expressing grave concerns about the rise of resource-backed currencies and the potential threat they pose to the dominance of the dollar. It's remarkable how $50 billion worth of African gold can make you the center of geopolitical attention overnight. Of course, with great opportunity comes great risk, and the skeptics are not wrong to raise concerns. Environmental groups are sounding the alarm about the potential for increased mining activity in sensitive forest reserves. Ghanaian labor unions are worried that the influx of Indian technology and firms could sideline local engineers and entrepreneurs. Macroeconomists caution that locking in such large payments in the local currency could fuel runaway inflation if national productivity doesn't keep pace with the new money supply. And then there's the long shadow of history. Is this a genuine partnership of equals, or will today's celebrated sovereignty simply morph into tomorrow's dependency, with New Delhi replacing London or Paris as the new center of power? These are fair and necessary questions. The deal reportedly includes an annual review clause, but enforcing it will require sustained political will, not just signatures on a piece of paper. Smash that like button if you want a deep dive into how Ghana's gold buying program is changing the game. And let me know in the comments, is Ghana pioneering a new path to economic freedom? Or is it just swapping one set of chains for another? I read every response, and the best ones always get pinned. The grand vision here extends far beyond a single deal. Imagine a future, a decade from now, where a network of African central banks hold their own substantial bullion reserves in their own vaults. Picture them pricing their exports in a basket of local currencies and making strategic trade deals directly with partners in Asia and South America, settled in rupees, yuan, or reals. Imagine India sourcing half of its gold from accredited, ethically certified African refineries, a move that would drastically cut price volatility and strengthen its own domestic financial markets. That future is no longer a distant dream. This agreement is paving the very path to that new reality. The age of we produce, they profit is finally fading. The age of we negotiate as equals has just begun. So let's break it down to the essentials. Remember these three things. First, Ghana transformed its economic fortunes by tripling its physical gold reserves in just a matter of months, all by making the simple, powerful decision to buy its own resources first. Second, India secured a decade-long supply line for its most critical strategic and cultural commodity without going through the traditional power brokers in London or New York. Third, the entire contract is priced and settled in local currencies, marking one of the most significant moves away from dollar dominance in modern history. When you put those three pieces together, you have something far more profound than a trade deal. You have a declaration of economic independence written in 24-karat ink. History doesn't always announce its arrival with loud fanfare. Sometimes it's a quiet memo from a government ministry in Accra, a cargo manifest from the port of Tema, or a simple entry in a central bank ledger that reads, "Receive 60 tons, payment settled." Tonight, that ledger entry is worth $50 billion, and it is rewriting the rules of the global economy in real time. The West had its turn. Now, others are stepping up to the table to trade, on their own terms, in their own currencies, and for their own futures.